Deal activity in the asset management space has returned to normalised levels, with divestments expected to remain a key feature. Alternative asset deals remain a significant part of activity, comprising around 1/3 of transactions. Now we're joined by Sandler O'Neill's Managing Director in Investment Banking, Chris Brown. Chris, you've mentioned that it's a buyer's market for asset management transactions. What sorts of assets or businesses are buyers willing to pay decent prices for?
Sure. We often say it in the market we're in, it's all about differentiated businesses and businesses that buyers can expect to see growth in the coming years. Your traditional asset classes have either gone very passive with the obviously huge emergence of the ETF market, and you also have buyers looking at what's really going to be the area where I see flows in the future, both institutionally and retail. Those areas are usually global asset classes and alternative asset management classes. So it's the traditional asset classes have definitely become crowded and less appealing to buyers, and most of the buyers have those asset classes filled today.
Okay, and more broadly, divestments make up about half of all deal activity. Is that an unusually high proportion for the sector, and what's that being driven by? Is it banks continuing to restructure?
Sure. Well, it started to come down a bit since the crisis, but it's still a healthy portion of deal activity. There's always going to be this core, non-core discussion that large, diversified financial institutions have. So is asset management going to continue to remain a core business for us, and are we going to keep it and grow it, or are we going to divest it? And if the decision is made to divest it, since the capital pressure that existed in 2009 is off, they can make the decision as best when to do that. So when is pricing going to be strong enough to entice us to do it? When is there going to be an appropriate buyer who could pay a compelling multiple for it? So divestitures will continue to remain a part of the business. I think over time it's going to come down because it hit a high in 2009, and we hadn't seen it that high. We haven't seen it at half of deal activity ever in my recollection. So I think it's going to remain strong, but it's going to taper down over time. But it won't be a sudden drop because there are still some owners of businesses out there who are making decisions about whether or not to stay in the business or exit.
Okay, and the new capital and regulatory requirements, especially that the larger banks face, how might this shape the way that they think about future asset management transactions? Are there certain types of businesses that are more punitive to acquire or that are more favourable?
Sure, I think alternative asset management businesses is the logical topic to go there because it's, you've had a lot of the larger banks cut down on their proprietary capital. Generally that went to alternative investing, whether it be hedge fund strategies or what have you. So I think that's the area where you're going to see it impacted the most. And you've already seen it. I think you've already seen some trading groups spin off from the banks and just form their own asset management firms. Many of those teams have track records and they have reputations with their clients. So spinning off those businesses is not as difficult as it would be for a much younger team or a less experienced team. So I think you're going to see that more so with hedge fund strategies, particularly as banks just stop allocating their own capital to them. Although the capital rules still allow a certain percentage of bank capital to go to those strategies. And I think many of the banks are quite below those levels. So I don't think there's this immediate pressure to do it. I think it just depends on the teams themselves, actually. If they don't feel as though they're going to be a recipient of capital going forward, I think they'll be the ones to make the decision to say, maybe we should leave and we're better off doing this on our own, and our clients will support us to do it.
Okay, you mentioned before that it's a difficult environment for traditional wealth managers. Broadly speaking, compared to pre-credit crisis days, are there particular types of asset management deals or a particular type of financing in the sector which is no longer being used? Or on the flip side, are we seeing new sorts of deals being done or a new type of deal structure after the crisis?
Sure. Well, that's actually an involved question. I think the asset management industry has evolved such that if you are a traditional U.S. growth or U.S. equity manager, unless you're doing something differentiated, to my point earlier, or unless you are performing at the top of your class, it's very hard to attract strategic interest if you were to look to do a transaction, for example. It's very hard to find a buyer who views your product and your track record as particularly valuable and differentiated and something that they could turn around and sell to their clients. Financing was dead for quite some time, but as we all know, the interest rate environment and the accommodative policies that the Fed has had has helped usher that back. So we actually have found over the past 2 years banks being much more willing to lend on transactions, whereas in the past, not only did the lending disappear, but when it came back, the lending amount and the multiples they were willing to lend to were quite suppressed. I think banks have gotten more comfortable and also have done somewhat out of need, because there really isn't a place for them to put their capital. Banks have spent a great deal of time raising capital since the crisis, and now they're looking to put that capital to work. And there's such a lack of yield that they can find in the marketplace. One of the ways to do so is to lend. And asset managers can be very interesting businesses to lend to, because they have very strong cash generative qualities. So you can have interest coverage and various ratios be pretty comfortable for banks, as long as the business is relatively stable.
Okay, thank you, Chris.
Sure.
That was Chris Brown from Sandler O'Neill, and I'm Jane Searle for The Deal.